Greetings, everyone. I'm David Darst, here to give you a recap of the month of July. It was an interesting month thus far. This year, we've had, of course, the artificial intelligence narrative, which has been driving things that seem to slow down a little bit in the month of July. You had earnings reports, of course, from Microsoft, Google, Meta, and so forth. They're doing well, the businesses are. But the narrative seems to have slowed down a little bit. Another narrative that took place in the month is the banks. The banks have done pretty well in the month. That narrative of the banks coming under pressure because of the Silicon Valley Bank, the Signature Bank, and the First Republic Bank problems back in March seems to have calmed down a lot. So there's another narrative now, which is the broadening out of liquid markets in the United States. That narrative has continued in the month. Recession narrative. There you have lead economic indicators. They were down for a 15th consecutive month, and they have a very good recession prediction ability and a track record. However, the economy's first quarter, second quarter, the early numbers on the second quarter, which were released in the month of July, were pretty, they're pretty good for the second quarter on top of the first quarter. So a couple of percent for each quarter looks like it's going to end up being that way. The inverted yield curve, we'll come back to that in a second. That narrative does continue, and that does trouble us somewhat and make us remain on recession watch. Home prices, they've been down now on a national basis, according to the Case-Shiller Home Price Index. They're down 0.5% for the most recent month, which was reported just recently at the end of July here. And the previous month, they were down 0.1%. So they've been down 2 consecutive months. It's kind of rare for them to be down to begin with, but why? Mortgage interest rates rising, less selling, less buying, because the inventory of existing homes is very, very, very low. People have to go to new homes if they're going to buy a home. The new home percentage, which is normally about maybe 15-20% of the total, it's up to maybe as much as 30% of the total. The next narrative for the month is the Fed. The Fed's interest rate increases of 5% plus, more than 5% over the past 18 months. They have done a constriction on housing, and they've done a constriction on construction. They have not done this to the services or to the labor markets, and that's what the Fed is concentrating on, because you don't want to get inflationary expectations built into labor's negotiating and into their thinking, and therefore you do not escape inflation. So the banks are down 13% for the year, but they had a good month. NASDAQ had kind of a up and down month. It was down at 1% for the first week of the month, up 3%, down another 1%. NASDAQ is, however, up 35% for the year, and that NASDAQ 100 is up 42% for the year. The two-year Treasury, 485, and the 10-year Treasury is at 391 towards the end of the month here. That's a 94 basis point negative inverted yield curve. That's also a predictor. It's been a very reliable predictor of recession over the past 8 or 9 recessions that have taken place since 1960. Every single one of them has been preceded. Does not mean it's guaranteed to happen this time, but that's one of the reasons why we're of the opinion that we will have a recession. It's being pushed out towards the very end of this year, or maybe into the first half of 2024. The Consumer Price Index and the Producer Price Index, both of those were released during the month of July, as you know. That's for the month of June now. People were celebrating the fact that the headline Consumer Price Index went from 4% year over year to 3% year over year in the month of June. That's good news. However, The core, which is stripping out food and energy costs, went from 5.3 to 4.8. So not as much of a decline there. And that's why the Fed remains, as we should remain, vigilant about the need to maintain a somewhat tight monetary policy. The dollar, the first week of July, the dollar was down 1%. The second week, it was down another 2%. The third week, it was up 1%. The reason is people are expecting, financial markets are expecting the Fed to be easing while some of the big counterparty currencies, you're talking about the British pound, you're talking about the Canadian dollar, you're talking about the euro, okay? Those, the indication has been that monetary policy is going to have to remain somewhat tight, and that's why you've had the dollar come under some pressure. The dollar towards the end of July here is down about 1.8% for the year. Oil had a very good month. Oil for the first week of the month was up 5%, the second week up 2%, the third week up another 2%. Oil is basically closing out the month here close to flat for the year, as you've seen production cut back to match or even offset the slower growth in demand from China's somewhat lackluster economic recovery. That would be one of the two surprises of this year that are most important to me. Number one is the strength of the U.S. economy in the first half. Very few people were looking at this as we came into this new year. People had come off a 19% decline in the stock market. And at the peak, from the peak to the bottom in 2022, the market actually declined 25%, the S&P 500. It rose about 6% between October and December, so it was down about 19% for the year. In terms of positioning, we think it's time for you can start to broaden out, just like the market is broadening out. We do like tech. You don't want to basically give up your exposure there, but maybe it's time to trim some of your technology positions and to begin to think about cyclicals. Although if we do have that recession, the cyclicals are going to. That's on the assumption that you actually have what's called a Goldilocks soft landing, in which inflation comes down, but the economy does not really slow or go into a much of a significant recession. That's a Goldilocks or soft landing scenario. So if there is that, that's why we're recommending diversification here. Some technology, a little bit of these cyclicals. And the cyclicals, as you know, are industrials. They are materials, basic materials. They are energy. And, of course, they are financials, which would benefit from interest rates staying in a positive level for the banks. You also, believe it or not, this group has had no friends so far this year, and that's your defensives. And you know what the defensives are. That's healthcare. They're basically flat here towards the end of July. They're flat. You've got also a consumer staples. That's not consumer discretionary, consumer staples. And finally, utilities, which are down about 6.5%, 7% thus far this year. So we always are thinking about alternatives, and there we continue our favorable view of alternatives, specifically private equity, and there you're getting some nice valuations, and you want to pick up some of the secondary interests and partnerships that are being sold at reasonably nice discounts and attractive entry levels. That's private equity. Private credit, there we've stressed being towards the high end of the capital structure, high up in the capital stack, and you can get decent yield there. And finally, private real estate, and there is where you want to be the most opportunistic of all, as the credit tightening that has basically been not severe, but it has been ongoing, puts some pressure on assets related to the real estate sector, and there the private real estate also can give you some yield. With that, we wish everyone a great start to the month of August, and we look forward to catching up with you very soon.